Hello, looks like we are good to go, as they say. Today we're going to be talking about an important subject in investing, and that of risk and reward. Some say risk versus reward, but risk and reward. So, in the context of what we're talking about, which is investing, what does risk entail? So I've heard a lot, and I know a lot of investors who purposely seek out risk because they believe that in the end, the riskier the investment, the greater the return. Unfortunately, this may be the case in general, but specifically speaking, is not the case, especially depending on what you are talking about. So let's take a look at something. So right now, in the market, in general, how do they pay for things? Why do some things get a better return than others? So what happens? Well, a business can do well, a business can do poorly. That certainly affects the returns of the business. But when you look at a thing we call diversification, if you own a piece of both businesses, then that factor is kind of eliminated, right? If you have a market and a market is supposed to do a certain amount of revenue, a certain amount of profits, and one gets a greater share than the other, greater than expected share than the other, but the total is the same, well, then you're not getting really paid for that. You're not getting paid for the risk of one versus the risk of the other. So what I'm talking about today is what we call in the business systematic risk, or systemic risk if you prefer. So essentially what it is that you have multiple types of risk in what we call, we break it down into systematic and unsystematic, or alpha and beta risk. So what's alpha and beta risk? What is systematic versus unsystematic risk? So there's risks within a particular company, right? And that might be what we consider the alpha risk within the certain company, of them doing what is expected of it. So the likelihood of these things. Well, that number boils down to what we expect as investors they'll make. Now, something that's beyond the control of the company, something we call systematic or system risk within the general system, is what that's systematic risk. So why does that differ? Well, for some companies, the amount of systematic risk is a lot greater than other companies. And what does that mean? It might seem vague. So essentially, it's this: how well the economy does will affect certain companies more than others. Let's say, if you have basic foodstuffs, the amount of basic foodstuff is going to be approximately the same whether the economy is doing a little poorly or if the economy is doing great. People are not going to be going out there and buying basic household goods in bulk because they got a bonus check, right? So a luxury brand might do better in the case of the economy doing well. So their systemic risk, their risk in the system is higher, right? A case in this, like this, might be Apple. I don't know if you've looked at Apple. Apple is a company that probably does better because they sell high-priced goods. Probably does better when the economy is doing well. Now, like I said, there could be a lot of reasons why a company would do better if the economy is doing well, or if it's does worse when the economy is doing poorly. Now, is that ratio always this like 1-to-1 ratio, or this simple math kind of ratio? No, not necessarily, of course, but we try to simplify things in finance for the most part. So that's the kind of risk, though, that the market pays for. They don't pay for the risk of within a company. Like, let's say the risk that a company's CEO goes and has an affair with a prostitute and puts that prostitute on the payroll. That kind of risk is separate. That's kind of risk that the market doesn't pay for. It might, yes, there's certainly risks like that in any particular company. You have risks, but those risks can be, I wouldn't say nullified, but can be reduced a great deal by the process of diversification. You could say, if you have companies that are competing against one another, well, if you spread your money out amongst those companies, you greatly reduce those alpha risks, because yes, it may affect that company, but as a whole, it may not affect the results of all those companies combined. So yes, company A might do worse, but company B and C might make up most of the slack. So that's the difference between alpha risk and beta risk and systematic and unsystematic risk. Unsystematic risk is risk it's that alpha risk. It's just associated with that company. That generally is reflected in the anticipated earnings, considering how well the economy is going to do is accounted for in that earnings number. But if you were to strip that out, people are making multiple estimates when they're looking at a company's earnings. They're looking at the systematic and unsystematic risk within an earnings projection. Those are two factors within there, but only a portion of that earnings is either. They don't strip it out, generally speaking, but you could strip it out and then determine on your own what the expected return is based upon those numbers. So there we go. That's basically what the market is paying for, this systematic risk. So let's focus on that for now. So how do we measure systematic risk? We measure it by the term beta. So beta is essentially, it's just a term that we use to make sure that, when we talk about beta, what we're looking at is companies. If we use all the companies in the world and put them together in a market portfolio, this is what we call the beta 1. It's all of the market, because then it's as diversified as possible, as long as the ratio is correct. It's as diversified as possible, right? So the economy is going to do what the economy does, right? So that's a beta of 1. Now, practically speaking, what's been used for the most part in most companies over the years is the S&P 500. Now, the S&P 500, I don't know if you've watched the other videos, but essentially the S&P 500, I'm going to bring it up real fast. If you go to one of your financial places and you look up the SPY, it's a S&P 500 a trust, basically an ETF type of thing that trades. And because of that, fortunately for us, Yahoo has it here. It has a beta of 1. So it's kind of been used as the default beta, the S&P 500. So what they do, the S&P 500 very briefly is almost the top 500 U.S. companies, and it just collects that data, and based on that, the return of the S&P 500, that's our base return for the economy as a whole. Obviously, it's not perfect, but it's close enough. So what they do then to figure out a beta of a company is then correlate the company's return to the S&P 500's return. And as we spoke of earlier, let's go to Yahoo Finance again. Bring up Apple. So this is Apple. And here we go. We have the beta for Apple. It's 1.29. So what does this 1.29 mean? You know, Apple is a part of the S&P 500. So, you know, even being a part of it, it has a higher beta than the S&P 500 itself. Apple's a pretty large part of the S&P 500. It's, I think it's almost 8% as of we speak, and we can look that up real fast just for those who holders. Where is it? Company insights. Where are you? I'm blind at the moment. I'm looking for holdings and not holders. But it's almost 8%. The S&P of the S&P 500, maybe a little bit lower because it looks like it had a down day yesterday. But that being the case, so it's a large part of the S&P 500. Remember, it's 500 companies. So if it was equal, it would be 0.2%. But it's actually 7%. So it's a lot bigger than most of the companies. I think Microsoft is actually the biggest portion of the S&P 500 as we speak, unless it had a down day as well, which it might have. Oh, that's why I'm looking at the wrong thing when I'm looking at, here's the holdings, the S&P 500. I apologize for that. But yeah, Apple's number one at 7%. Oh, I thought it was closer to 8, but okay, it's 7%. Microsoft is second at 6.96%. So yes, the S&P is definitely top heavy, but that's okay. That's just a part of what's going on. So when we take a look at that now, this number, let's go back to Apple, this beta of 1.29, what are we looking at? We are looking at a company whose expected results are going to be affected 29% higher, that portion of the results that will be affected by the economy is going to be 29% higher. So let's go back just 1 second. So when we're looking at the required rate of return, so that's essentially what we're talking about when we're talking about risk and rewards. The reward should be the required rate of return. Now, what's the required rate of return? So, generally speaking, the more systematic risk there is, the higher this number is, the greater the reward should be. Now, what should that reward be? You know, what exactly should that reward be? Well, that's a number you got to kind of figure out. It's not a readily available number or published number, but what you can do is you can look at what's expected of the S&P 500. Right? What's the expected return of the S&P 500? Let's just do it real fast here. Expected return S&P 500 2024. Okay. Earnings 11.6%. Price target of 5,029. Right, so that's pretty straightforward. What's the S&P 500 right now? Price of S&P 500. So 4868. 4868, and what was the number we were looking at? 5,029. 4868, 5,029. I gotta pull out a calculator for this. 5,029 divided by 4868. So they're only expecting a 3% return? Is that possible? Is that crazy? There's no way this number can reflect reality, right? Of course, this occurred before? This was probably at the beginning of the year. Let's see. Oh, here we go. Let's look at the year-to-date number. So this number is 4750. Right. Let's take that number. Whoops. 4750. So that's a 5.8. We'll round. We'll do some rounding. 6% return. I don't know if that's the closing number or not. But anyways, so 6%, a 6% return. So what's this 6% return or expected return made of? Well, part of it is made of the what we call the risk-free rate when we're doing this equation. So what's the risk-free rate? Well, the risk-free rate, generally speaking, for most companies when they're using the 10-year rate here, this 4.178% rate right now. So what's added to that? Well, the next portion that's added to that is the beta rate. Now, if we look at the S&P 500, the beta rate is 1, right? That's the default. The default number is 1, right? So what's next? So we take this 4.178%, and we subtract 6%. We take 6% and subtract this 4.178%. So approximately 1.8% is all that is expected for this beta return. That number seems pretty small, and I'm going to guess that that's pretty conservative based upon what the market is pricing in. So the market is saying that's wrong, right? There's no way your risk premium is going to be 1.8% unless the market has mispriced things, which is possible. I would expect at least something closer to the 4 or 5% for a beta of 1. So a total return closer to 8% versus 6%. Because 6% you're talking about, for taking all that risk, you're going to get paid less than 2% over the next year. So that seems like a little low, if you believe the consensus according to Google. So my guess is that that's wrong. One way or the other, it's wrong. So not that the return won't be what they expected, but the market has not priced that in properly. There's obviously ways that could be probably priced, but unlikely. So, in this case, you have to decide for yourself as an investor, does that make sense? For me personally, I don't think that makes sense. I think that the expectation is probably set too low. You're going to have to get 8%. It doesn't make that much sense to risk your money for a beta of 1 and for a return. Well, I take it back. Let me take a little bit of it back. So maybe they're not including this yield of 1.4. Okay, my mistake. That makes a little more sense. That's closer to 4, right? 1.8, 1.4, 3.2%. So makes a little bit more sense. I'm sure that number is going to be getting revised up, right? Like I said, it just seems a little low in comparison to what you can get for the 10-year. So there was a time that back when I was in school, we were using numbers like 7% was kind of the standard beta, 7%, which seemed high at the time. But 7% was the expected return. And I do apologize for that. I forgot about the yield. The yield's important. If you don't know what the yield is, that's just the dividends that are expected from the company. In other words, the return from the S&P 500, the cash returns and dividends. So, but that's what you have to look at. That's just the basics of what you have to look at. But now, when you take a look at Apple, let's say beta is supposed to be 4%. So how would you figure that for Apple? What should you expect? Well, you multiply that 29%, that 1.29 times 4%, right? So now you got a number that's a little over 5. So yeah, the S&P, let's say the beta risk rate of return or expected, the risk premium should be 4%. Let's just throw that number out there. Then you would expect a return of 8% from SPY. But also, let's take a look now at the expected return for Apple, right? So what should that be? Well, we know 4 times 1.29 is a number slightly higher than 5. So 5 plus the 4 gets you 9. So, you're talking about you shouldn't buy Apple unless you can get it at a price that makes you feel as though you're going to get 9%, right? Because you need to get paid for that. And that's one of the things as an investor that you need to be cognizant of. You need to make sure that you are getting the return, the required rate of return. The market doesn't hand it to you. You have to make sure you are getting it. You should understand it. You should have an understanding of Apple to a point that you feel confident that you're going to be getting at least 9%. Now, yes, there's some other things that you need to consider. One is the beta itself. Now, the beta as calculated by Yahoo, of course, is a historical beta. So historically, I think they do 5 years, and they take the average price of the month and correlate that to the average monthly price for the last 5 years of the S&P 500 to get that 1.29%. So with that in mind, is that number too high? Is that beta number too high? Maybe you think that, Apple's such a huge company and it's such a huge part of the S&P 500 that that beta is excessive. 1.29 does seem high to me for a company so large that, their prospects, depending on the economy, will grow that much if the economy is doing well, and do that poorly if the economy is doing poorly. So something to consider. Now, there's another way you can look at it, and that's essentially this. For the most part, these markets are extremely efficient, meaning that there are enough people trading in Apple and SPY, or the S&P and 500 in general, that an investor doesn't need to worry that much about the risk premium because it is built in. And that's not the worst way to look at it. Certainly when you're dealing with companies that are extremely well traded, and when you're talking about the S&P 500, which is extremely well traded. So yes, you can kind of back into it without doing the equation that yes, because of market efficiency theories, you don't need to worry. The risk reward is properly set. So, you can go back and you can look at it and determine, you can use these numbers to kind of look at other companies that may not be as efficient. So companies that aren't as efficient, aren't traded so well, that don't have as many people making markets in it, that don't have as many people ensuring that the price makes some kind of sense. Well, there might be opportunities, but those also have greater risks. So, You've got to be careful and make sure that you're getting paid for those risks, that the alpha risks are being taken care of, and that the beta risk is calculated correctly. So, what else? Well, I hope you get from this that essentially, when we're talking about risk, realize that one, investors only get paid for beta risks, not alpha risks. Two, that you need to ensure that you are getting the required rate of return. Yes, for efficient portfolio, efficient markets, generally speaking, you don't need to worry about it that much. But for stocks that aren't thinly traded, you definitely have to worry that the beta is correct and that the stock is being handled correctly. So, and you might have to do a lot of calculations and put forth a lot of thought to ensure that everything is being priced correctly. So it's definitely more work. But that's it for now. We'll get back to this in the future. It's a fascinating topic, risk and return, and making sure you look at it and you might say to yourself that the higher the return, it's always a better deal. But if I told you that if the economy did poorly, you would make less. But if I told you there was some risk involved, but the return was going to be just slightly better, is expected to be slightly better. So let's say, and this isn't the worst example, the S&P 500, say it's trading at 4. Right now, what did we look at? I think the return was 3%. So if you truly, well, let's say it was 4.1%, would it be worth the risk, to take the S&P 500 for a 0.1% return when you could have a U.S. Treasury that's guaranteed at 4%? So I would hope you would say no to that, and that's ultimately the balancing job you do as an investor, and making sure you're getting paid for the risks you're taking. And as a professional investor, as somebody who's trying to make money in a rational way, you want to do that by balancing the amount of risk with the amount of expected returns. So that's it for now. I've actually run out of time, unfortunately. I could talk about this for days and days and days, because it is a fascinating subject and one that can be very confusing to a lot of people. And it's one you kind of need to sort out if you really want to get good at investing. Like I said, if you just deal in efficient markets, you can kind of get away with not doing that, not doing all the calculations, not understanding completely what you're getting involved in. That certainly limits what's available to you, which, look, limitations, know your limits, I guess. Thank you so much, and I will get back to you in the future.